Good morning. Welcome to the Brew. I'm your host, Lex. Today is Traders Workshop. Our topic today is strike selection. So options have lots of strikes. We as retail traders have to figure out which ones to choose. So Mark and I are going to break this down and get deep into how we choose strikes. So let's get to it on the Brew. Oh, wow, Mark. A little lead-in music.
Yeah, it's like your walk-on music. I love it.
I like it. Pretty cool. How you doing?
I'm doing pretty well. I'm excited to talk about strikes. This is a topic that's near and dear to my heart.
Yeah, I know you. So in the till, you wrote about this, and the till is your blog. Is that? I don't want to be misspeaking here.
Thetil.substack.com.
Okay, that's
blog every week. Got one coming out in a couple hours.
Okay, Mark writes great articles. I love them. I love when I get them. And the Dolly images are pretty darn good too, must say.
We're very simpatico on that. I think.
Yeah, we're very simpatico.
Mutual shared appreciation.
Okay, second of all, before we get started, no Jason today. Jason is at a very important 5th grade graduation. So his 5th grade graduation, that is. So he won't be with us today. I tease him a little bit. I don't think I had a 5th grade graduation. I don't know. I'm an old schooler. We didn't do graduations.
You made it through 5th grade though, right?
Barely. Okay. Yeah. All traders have no education, just street smarts, right?
Just addition and subtraction.
That's right. Okay, how do we start, Mark? I'm gonna let you lead the show here. I'm gonna take notes and we're gonna have a little recap at the end. I'll add to it too. Don't worry.
Sure. So I say this is like a topic near and dear to my heart, and it sounds very simple, but like strike listings are really what like define the equity options that we trade, right? Like it all comes down to the strike. Like if you're long the 550, if it closes above that and you're long a call, that's where your profit zone is, right? Like they're kind of the building block of any strategy.
Mm-hmm. Right. Okay.
And as a retail trader on the buy side, you're thinking about how I can set up my strikes to achieve the perfect position, whether it's legs of a strategy, whether it's which call to write or whatnot. But on the other side is like dealers, kind of who are providing the trade to you. Like lots of strikes have their own issues too, right? Too many strikes, capital gets split, too many strikes to quote, too many things going on. Yep. So, it's a really interesting battle of like these two sides and where they're going to choose to meet and where the P&L is going to be defined at.
Yeah. And it's important to know too, that for the, the retail folks, the way dealers deal with strikes is they don't deal with them. They quote in everything that they're assigned to. Right. And I would say that back in the day when I was doing this on the market maker side, I probably didn't like trading or having to quote far out of the money strikes. I mean, just wasn't my favorite thing, like out in time, way away from the at the money wasn't my favorite thing to have to quote, because it's kind of like a little, it's Frankenstein floating out on the iceberg out there somewhere. And, how do you pull it back in? Ooh, I get the
exactly. And more strikes are more, risk questions to start asking. You want to trade where there's the most liquidity. That tends to be at the money in the front month, less than 30 days. I mean, less than a week really these days. But you feel comfortable where there's open interest, and fewer strikes means open interest is concentrated in more places.
Yeah. Do you think that the exchanges and the powers that be have listed too many strikes in general? I mean, are there too many out there, or not so much?
Which hat am I putting on? But I think in general, I'm in favor of more strikes, because on the negative side of the equation, there definitely are some negatives: computational power, bandwidth. All of that's a technology problem, right? We can get more, faster computers, bigger pipes, and all that. Mm-hmm. The capital one, I think, is the main negative for it. But at the end of the day, I think that's dealers' job to provide liquidity, and they'll deploy their capital where it's effective. Mm-hmm. And I think more strikes have gotten people trading more. I think more strikes in the terms of the numbers listed within a given expiration, do we have the 500, the 550, et cetera? Mm-hmm. But look at 0 DTEs alone, right? Adding that tenor has been a, steady, positive, organic growth for the industry.
Right. Okay. Fair enough. So you're not opposed to more strikes. It sounds like you're in favor of that. So that's good.
I think on the buy side, right, like it allows you to customize your strategy. You know,
Mhm.
you can, if strikes are $5 apart, and we'll actually take a look at this in my tool in a couple of minutes, but like, do you sell the 500 or the 550 call?
Right.
What if you get the 505? That fits your delta percentage target a little bit more. So like, I think that allows for customization at that level.
Yep.
Which allows for more different strategies.
Sure. Okay. That's fair. And then you're okay then with dollar strikes, and maybe even $half strikes, if I'm hearing this right.
I think if they're done in the appropriate places, right? Like I don't think we need 50-cent strikes on, $1,000 stock.
Sure.
But they're nice in SPY, which is a $540 stock, because that does have the liquidity and like price action and, the granular definitions you can
Sure.
get. So I think, and like the industry has a plan to regulate this, right? We have the options listing, OLPP, options listing procedure plan,
Mhm.
what it stands for, that defines what names can get dollar strikes. Exchanges get to nominate them, when you can list LEAP products, so like there is some, consensus on regulating that, but
Right. Okay. All right, so let's get into this then. How why is it important for the retail folks strike selection? How do we do it? What's some good tips? Where do you want to take this on this one? I know you have some slides to show too.
Yeah, I have a tool on my my software, the tape, and I wanted like a common strategy, like the retail 101, the covered call, right?
Mhm.
Favorite benchmark strategy.
Right.
Sell out of the money calls on stock you are long. Love
Yep.
it. Works for so many different reasons we don't have to get into here. But the parameters of that strategy are going to be defined by what strikes are listed. And any given month, you could sell a covered call once, buy stock, sell the call, and make that trade. But often we think about this more like I want to sell the 25 delta calls, or I want to sell the 2% out of the money calls every month. Like that's my strategy to collect income on my Apple position or SPY position or whatever your underlying might be. So when you're trying to target that month over month, sometimes you get the 525, sometimes you get the 527. Like picking between those is a debate. Do you accept more upside? Do you accept more cash?
Mhm.
And so actually if we want to pull up the screen share, I will show my strike finder tool that helps compare some of those different things, right? Because with a covered call, you get, so I'm going to go to the strike finder. Let's look at SPY because it's got tons of stuff.
Okay. This is
So
pretty cool.
we'll select a covered call.
Yep.
We can get into the hedged equity trade later because that has even more strikes to pick from. Set a target DTE, and then it'll give you the expirations around that. So you generally like to go out a month. Maybe you want to go more than a month to make sure your covered calls are qualified for tax reasons.
Okay.
But what are the different expirations we have? Do I go 21 days? Do I go 35? Do I go 28? Do we want to look by delta or do we want to look by percent out of the money? I like doing delta because it normalizes across volatility environments, right?
Yep.
Sell a 25 delta call. Sometimes that's further out of the money. Sometimes that's closer.
Yeah, and the reason for that is just so we're clear. So for some of the beginners is that depending on how high that volatility is, that pushes that 25 delta farther away from at the money, right? And in low volatility environments, that 25 delta comes closer to at the money. So that's a big deal, understanding where that exists relative to implied volatilities as well, right?
Yep, and it means you're probably collecting a little bit more premium in higher vol environments and getting more upside also,
Yep.
and probably less in lower vol environments, as opposed to a fixed cash amount, say is your optimization.
Right, exactly. Okay, then you punch these in. Where I'm looking at this now. So you enter your target delta, you put 25.
Yep.
Okay.
And
Perfect.
so the best fit for a 25 delta covered call out 30 days is actually going to be out. I think that's 28 days to July 12th.
Yep.
553 is exactly 25 delta. That's why I love SPY and like strike proliferation, because you can get that exact 25 delta.
Right.
You can even at the 552 and a half, you're at 26 delta. You can really parse this pretty finely.
Got it.
So we're 1.8% out of the money.
Okay.
That call is worth 0.43% of the stock price, 232 over 552.
Okay.
So you're going to collect that premium and you get 1.8% upside at 25 delta 30 days.
Okay.
Max return being the combination of those two.
Right. Right. Okay. So the max return is right at that strike price at expiration, right?
From there on up. Yep.
Yep. Okay. Got it. And then max loss is okay. Perfect.
So then we
Um,
can kind of take a look here and see how these different other nearest kind of neighbors might fit in space. So we had our like perfect or 553 July 12th right here.
mhm,
If we go out to the 560 and out another week, we could get 3.5% return.
mhm.
We do a week shorter and cut it even, down to the 550 strike, we're only getting 1.7%.
Okay.
So this sort of plot visualizes our return against the different expirations and strike
Mhm.
levels.
Yeah. Do you find do you find that retail folks like to do this more frequently, like with weeklies, so that they're collecting premium and putting it in the bank, banking it more often, or do they pick this 30-day kind of structure, or is it kind of a mix of both? I suppose. I guess that could be true too.
Um, I think if I were to really parse it, I would say people like cash secured puts on a weekly basis and covered calls closer to a monthly basis.
Cover call. Okay, fair.
They're
And
both obviously long delta trades, right?
yep,
But I think from a premium collection standpoint, puts tend to be shorter term, and the calls tend to be, because you've got more equity invested in theory. Obviously,
right.
you're putting up the capital of the strike on a put, but I think calls tend to be used to overwrite fundamental investments, so they
Mhm,
tend to push out that horizon a little bit longer,
right.
whereas cash puts are more opportunistic.
Okay, fair. Um, so what about other kinds of strategies? Like let's take very popular in the retail world are these the short iron condors, selling a put spread, selling a call spread. Always a trick or at least a struggle of sorts to figure out where you place the put side, where you place the call side. Any advice there on the strike selection and how far, are the longs from the shorts? Right? So that's a little bit, it's four legs. I get it, and it becomes a little bit more difficult. Any advice on that one?
So I don't have anything to plot condors for you quite yet,
Okay.
but I'll riff on the idea a little bit because, like you say, like are we centering them? Oftentimes you can even use an off-center condor to give your play a little bit of delta, right?
Hmm.
I think that's an axe. The width, the max risk, how close you want to get to the center strike. Um, I use some tools, some backhand calculations in terms of like delta of my short compared to my risk. So
Hmm.
I use the delta of my short leg and a short condor to think about, okay, what's the probability that it breaks through and hits my max loss?
Right.
Obviously, there's a spectrum of losses between your short strike and long strike,
Hmm.
but just as a proxy, am I willing to accept a 15% chance? So I sell the 15 delta. Do I want to make it look a little bit more like a butterfly and pull that closer to 30 or 40 delta?
Hmm.
Think about that delta probability versus your loss potential.
Okay. So it sounds like then you as a trader then have to have some sort of goal in terms of the stock price goal for a covered call, and same with the iron condors. You want it to stay in a range, that sort of thing. So you have to have some sort of opinion on, you know is my stock traveling up, and then where do I want to hit this short strike for a covered call. How much protection do I need to give myself for the iron condor, that sort of thing. So you as a user have to have a little bit of a basis to start with, right? Or no?
Yeah, I think so. And I mean, like, I think at the end of the day, like, one of the things that strikes point out is that, like, you might be making a volatility trade and all that, but like, there's a defined point where that matters and doesn't matter. Like, there's a very path dependent kind of outcome
Right.
because you are long or short a very specific strike. So, well, you might say, oh, okay, is vol high or low? Is this a better or worse time to do, my condor or cover call or whatever? Like, knowing where you think something's going to go, or having, I should say, having an opinion about that
Yeah.
matters because you're long and short strikes at the end of the day.
Yeah. Yeah. I think too, one of the things I've been using a little bit, and again, this is so opposite of how you and I used to behave as floor traders, um, especially for iron condors, is, I started looking at deltas a little bit. And then I'm like, that helps. That's good, especially as it normalizes volatility that's out there. And then I started looking at premium levels of my short option. Now it sounds like, what are you talking about? It sounds dumb in a way, but I find that the best dollar value option to sell, especially on a zero DT, is like a $2 option, $2 to $3 option. So I have my system look for that first $3 option, assess delta, assess how far it is out of the money, and then if it's too close and I get uncomfortable, I move to start moving down to the $2, and I won't go beneath that generally. And then where I place my long on the Iron Condor is my risk threshold. How much capital I have, how much am I willing to risk? Because each time, if we do a $5 one, we can max lose that $5 less what we sell it for. $10, well, it's $10 now. 15, it's 15. So the farther you place those apart from each other, the more risk involved, but also the more reward, right?
Yeah, exactly. I mean, people think about prices in dollars and cents, right? Stock moves up X dollars. Obviously we're talking percents too, but like it's a much easier risk framing to say, I got $10 on the line here times X number of contracts, or I'm paying $3 to win $7 on this spread. Like that intuits, I think, pretty well. And you can gut check, like you say, as a strike selection thing. Hey, I want to target collecting $2 a week in this. $2 is cutting it too close. Like you feel that in a way that you don't feel percentages.
Right.
So I'm totally in favor of thinking about things in that lens too.
Yeah, it takes a lot of the complexity out of the deltas, all the Greeks, all that sort of thing. So it takes that out of it for folks who are looking to do that. And again, we as retail folks, we don't, I don't want to say we don't care, but I'm not as dependent on my delta profile. I'm sorry, my Greek profile as I was as a floor trader. Just not as important to me. I'm doing a trade at a price and looking to harvest that theta in a sense. I gotta hit the bell for that because that's harvesting theta. So I'm looking to do that, right? And I need that action. And what I see a lot of the zero DTE folks, especially, is they're selling these condors maybe earlier in the morning, not right away, and then taking them off before a certain time of day because the back end of the day tends to be very whippy in terms of direction. So they take their whatever it is they can harvest, and they move on to the next adventure, right? And look, that's not a bad strategy. It really isn't. But again, the strike selection is super important. Where do you hit that short to take care of it, right?
Couldn't agree more. I think I was saying in our episode about brokerage features that I would rather have the what if scenario analysis of what my dollar and profit dollar and loss is at different strikes than I'd rather know my gamma.
Right. I agree with that.
From a trader, like a most buy side's perspective, knowing what your break evens are, knowing how much you're paying, how much you're going to win in dollars or percent, is more important than even most of the first order Greeks.
Sure. 100%. What about probability of profit? So we can build these spreads now, no matter what they are, and we could hit a button technically and come up with a probability of profit, right? So we can do a very simple calculation. And I always refer to it as my reward to risk calculation. Okay. So what I like to do there is I like to say the maximum dollar amount of my profit times the probability of that profit, right? And I'm just writing this down so we can refer to it later. And that's a quantity divided by, right, the dollar amount of my loss, right, times the probability of that loss. Okay, and we'll show this a little bit later. So that comes out to a value. I like that value to be 2.5 times to 1 or more. So my reward 2.5 times what my loss is. Now, if we throw in the expected value of that spread with a Monte Carlo simulation or something, you can come up to showing what does that spread expect you to make every time you put it on. And you'd be surprised. Some of these high probability of profit spreads are actually negative expected values, right? So we want to find, if you have a tool that has an expected value function, it's really, really helpful, I'd say. Any thoughts on any of this gobbledygook?
No, I totally love using that kind of juxtaposition to relativize the prices you see in implied vol terms, right? Like there's all the skew and there's all the, complicated IV, calculations that go into it. But at the end of the day, if you're assigning your own probability of something and your gains and your losses and framing those, ideally with a little bit of a bias, right? Because that's the reason you would trade against the market, is because you have some degree of bias.
Right.
That's where you're going to find your edge, where your expectation and probability distribution is different than what the markets is giving you.
Sure. Now, would you ever take a 30-day term and sell a slightly in the money call against your long stock position? You're going to have premium in it, right? It's going to give you a little bit better downside protection.
Mm-hmm.
You're going to have a bigger premium to it. Is that ever a play for you? Because I know people who do that.
I would say that I know people that do that. I don't personally do that, but I absolutely understand the strategy. And I mean, I think with the right types of names, that works pretty well. Like one good example of a name where I think overwriting in the money calls at a medium duration makes sense is some of these like leveraged products where they have their built-in decay to them. That like there's an inherent churn, similar to like what's in the BTC BITO product. That there's like a negative roll to that aspect. That's going to like churn, negative fees or expenses for the underlying. Then that I think is an attractive strategy.
Okay, fair enough. What about the
long interest rates pricing that anyway?
Yeah, right. Okay. What about the long side of buying options? Meaning, the little lotto tickets. So one of my 7 traits that great options traders possess is they never buy naked, very important, out of the money options, just straight naked, like a 2 delta option just on a flyer. Now, I get it. We all play roulette. We all play the slot machines. We know we're dogs in that game, just like you're a dog in buying a 2 delta option. But occasionally the GME kind of rolls around and you hit a long ball home run. So any advice on that? I'm very against using naked deep out of the money options unless you're covering a short somewhere closer and you need it for risk purposes for your clearing firm at your brokerage. That's the only time I like to use it, right? Otherwise, I'd be selling strangles all the time and forgetting about the other side, right? So what are your thoughts there?
I think those kind of out of the money options are the exact place on the road where theory meets practice. And the practice says that this is 2 cents and 3 cents, and it has to be at least a nickel or whatever it ends up being, because there's no way someone is going to sell that for cheaper, because you need some, actual physical cash in the bank, even as little as a penny or a cabinet, to collect on that, no matter what the volatility curve says. Right. So kind of by theory, those are the most expensive on the board. So why would you ever be long those, like you say, except to against another short? But I think the practice says that like there's nothing like the thrill of hitting on something like that, and it's only 2 cents. And how many people still play the state lottery and whatnot? So,
right.
I could put on both hats for that trade.
Yeah. Yep. Yeah, I think as your only strategy, that's a bad one. I think I always like to say those are clearing firm options, meaning they cover your risk so that the clearing firm says, okay, his risk is now defined. Let's not worry about it, right? So that's about it.
Totally.
And I think a pretty good strategy too, if you want to be long options, net long options, I love ratioed spreads. So if you need to find a way to take advantage of what you perceive to be some massive upside potential and volatility is at the right spot, you can buy 2 options at 2 calls and sell 1 call beneath it, or, somewhere beneath it. And again, that's back to strike selection. How far do you separate the long from the short, right? Also very important, because your risk in buying 2, selling 1 on a call side, right, becomes that long strike, the difference between that short and that long. So if it hits that long strike and dies there, you're going to lose maximum.
Yep, that valley's brutal. So it kind of and it kind of goes down. And then if if the stock runs beyond that long strike, a great day, you have an extra one every time, right? So it's huge. Yep, and I think where I'd tie that again to strike selection is like a trade like that. I like to do like a 2x1 or 1x2 out a little bit further in expiration, right? Like maybe at like the 60, 90 day range.
Yep.
because that gives you some time to manage it, right? If you
Mhm.
don't see your thesis performing after 30, 45 days, you can still get out of that valley.
Sure.
That valley is not so bad at all, still with half the time on the clock.
Right.
Where that valley really happens is like off that theta cliff and like you're sitting right there.
Yep.
So you can do some trade management mid-term on that trade. And if you have the strikes to roll it out and back, you're in a better position. But if it's one of those kind of chunky expirations that the new one hasn't rolled on yet, like you do get in sort of a pinch there.
Yeah, and one of the nice things about that strategy, buying twos to everyone you're signing, it could be 3, 4, 5. The ratios are, again, a risk parameter that you have to decide about. I love doing those in low implied volatility environments because buying 2 of those cheap little options and selling one sometimes gives you a nice little credit, right? And if you're doing this out of the money and you don't, your vision of this stock exploding doesn't happen, you're still collect the credit, right? So your risk, again, is where that long strike lies. So I like to do that. And I think you're right. I think it's a good point that it tends to take a little bit of a middle term sort of expiration to see success with a strategy like that, right? Because it buys you time, obviously, and that's what you're trying to do. Where you can mess that trade up is if it's not explosive and doesn't gap beyond that long and it kind of grinds up, then what do you do, right? Because you're going to panic. It's going to start looking bad at some point. So how do you manage that pain in your mind when that happens, right?
Yeah, I think you got to set a time limit on that. Like if you're going out 90 days, then at 45 days, either cut bait or or take your profits, right? Like if your thesis materialized.
Yeah.
The good thing on the downside is if you're completely wrong, then you've lost relatively little.
Maybe or made the credit.
Exactly.
Yeah, or made the credit. And I like to do those for credits for sure. That tends to happen
25, in 15 delta range.
Yep.
You can often get a decent credit. Because they're close enough that the prices offset enough, but they're also far enough out that it gets cheap. So strike selection, again, you need to have a 15 delta and you need to have a 25 delta, right? Like if you have $5 strikes apart in a $25 stock, you're not going to be able to do a 1x2 like that.
Right. Agreed. Okay. Fair enough. Anything else we missed on this one? Do you think? I'm trying to think.
No, I think strike proliferation and strike count management is a balance, right? Too many and things start to get too thin, and if you put them in the wrong places where there's not enough liquidity, that can be a net negative. But I think for the most part, more strikes are better to the extent that it brings more organic new strategies with multiple legs, strategies that can roll more actively. All of that's a boon for both buy side and sell side liquidity providers.
Right. Agree. Good. All right. Awesome. That was very good. So make sure you place some comments in the comment field if you have questions or comments. Don't forget to subscribe to hub.tradier.com. And don't forget to check Mark out at harvestedfinancial.com. Is that all right?
That's all right. And you can find a link to the tape report where you can play with this strike finder yourself for covered calls and hedged equity trades.
Is that all free for the user, or do
That's all free for the user?
I love free. It's unbelievable.
Free 99, the best price.
There you go. Free 99. I love it. All right, Mark. Well, you have a great weekend coming up here, and I know there's going to be wine involved. I already get it. It's already happening, right?
You do the same, and I know the same is true for you. So enjoy. All day.
All right, brother. Good to see you. I'll see you next Thursday. Probably talk to you beforehand, and you have a great day. And what else?
Happy trading.
Happy trading. See you, bud.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.